Friends from the internet, and welcome back to another episode of attempting to turn 10k to 100k over time. So again, as you can see from my portfolio holdings here, I have not bought anything yet because I was trying to really time the bottom last week, and my orders didn't get filled again. This is a very bad habit of mine. I probably should just take the market order, right, to get into positions rather than just letting my money sit here while the market is doing its thing. So yeah, let's do our weekly market review. So let's first go to the top 3 things that happened last week. So number 1 to me is the Fed's members' comments. So number 1, Logan, which is a voting member in 2026, thinks that the rate cut last month is appropriate, but indicated so far that the cooling is gradual and that she is not eager to cut rates further. Then, while on the other hand, Miran, who is recently appointed by Donald Trump, wants aggressive rate cuts, citing the impact of Trump's policy onto the Feds, right? So the Logan's sentiments sort of reflect Powell's, right? They are cautiously cutting rate in light of inflation risk. So they're talking about inflation risk from the tariffs and maybe the impact of actually cutting rates itself and what would lead to the inflation, which is still above the Fed's long-term target of 2%, and it's showing some form of stickiness, but it is gradually declining to the 2% mark. So Miran, on the other hand, is recently appointed by Trump, and also which is why he will likely push the rate cut narrative further. So his stance, right, something to note that is very different from existing policymakers who are worried about inflation risk. So it's basically just him versus the other members who are sort of taking the approach that Powell is taking, right? They're very data reliant. They're afraid of inflation coming back to bite them, to fight off this short-term weakness in job numbers, right? So my view is that the Fed generally will still remain cautiously, not hawkish, right? Dovish, right? Unless proven otherwise, because there's no point that they make a stance that they're gonna cut rates. They're confident, and then they're saying that the tariffs impact could be one-off, and they're looking to cut rates to fight off the short-term weakness in the job market. So that said, there is no point attempting to predict the economics and whatever all this data, what the Fed would do, because they themselves sometimes get it wrong, right? So I think the best option for now is just to rebalance the portfolio and position it accordingly to the amount of hittiness of the market, right? How hot valuations is, if there are any clear narratives or tailwinds to push the market further, or is there headwinds that you have to worry about. But I think that the things that really will push your portfolio down is the black swans, which at the same time they have no point really predicting it, right? And so far the market's just been on it's past all-time highs. It's it's price discovery. There is a lot of liquidity flowing back to the markets from all your risk off people not becoming risk on because of lower yields on your treasuries, things like that. So there is really no point to try to fight off this bullishness in the market for now. But at the same time, as things get more heated, valuation gets higher, you should just be more cautious about maybe taking profits or to move some allocation to cash. But overall, you should still stay invested. That's my opinion. And number 2, the government shutdown. So this happens once in 2018, right? But historically, its impact on the market is quite limited, right? So I looked at some data in the past. So since 1976, any shutdowns, right, doesn't really impact the market at all. It's roughly flat on average during shutdowns, right? The market performs very neutral. And but the thing to note is whenever there's a government shutdown, a lot of your data provided by all these bureaucracies, part of departments as affiliated with the government, will not be issuing the data. So the Labour Department, for example, did not publish its usual monthly job report on Friday as a result. So its impact, let me show you, explain further. Again, this is something to show about the chart of how stocks performed during the previous 2018-19 shutdown. It actually continued going up. So there's really no point in taking this shutdown news too heavily into account, right? If you're looking to trade around this volatility. But one thing to note that if this is prolonged, it could lead to confusion in the Fed's monetary policy path, right? Because there isn't enough data to help guide decisions. There's no up-to-date data. So whatever that's released could be lagging in some sense, right? which could may cause some jittery in the short and medium term, especially since the majority of the Fed members right now are still very data dependent in their decision making process, right? And I think I was looking at an article that said that lengthy shutdown could drag on GDP. So Oxford Economics estimated that a partial government shutdown reduces economic growth by between 0.1 to 0.2% per week on your quarterly GDP, right? So if a shutdown that lasts the entire quarter could reduce the GDP growth by 1.2 to 2.4%, which is insane. So there is really no incentives from everyone to shut down the government, because you're just gonna drag down on growth. They're gonna have the data that the Fed needs to help be more certain in their policy cutting and the policy path, right? And yeah, it may just weigh down on consumer sentiments, right? So the 2018-19 shutdown lasted over 30 days, coincided with a 7% hit to confidence, right? So I think this shutdown is important in a sense, in the economic terms of the perspective of things, because we are attempting to the Fed is attempting to tackle weakness in the job market in the short term, while balancing interest rates and long-term inflation risk. So the Fed does not want to make any extreme moves when they're in a tight spot of attempting to balance both, right? So especially since Powell has been a little bit more cautious in his statements over the past last week, if I remember correctly, last week he was a bit cautious in his tone. So, and he's a very data reliant guy. So if his data is not it's not clear to him, it's not clean enough, it's not predictive enough, he may just take a more chill out approach and wait things out and maybe not cut as aggressively as everyone expects to. But let's see about that, right? Number 3, economics data. So job numbers. Jobs was mostly in line. ADP non-farm employment change, negative 32 versus 52k expected versus 3k prior month. So this means that the job market in the short term is pretty quite weak actually. Economic activity, ISM manufacturing 49.1 versus 49 expected, and against 48.7 last month. So any number below 50 is a contraction, right? So the economy is actually showing signs that it's slowing down. ISM services, which accounts, social services accounts for a bigger part of the US economy, right? And it's at 50 versus 51.8 last month, versus 51.8 expected and 52 last month. So this actually means that the economy is slowing down. So the jobs and the economy seems to be slowing slightly, which helps Powell's case for stick to the rate cut plans. But as I mentioned earlier, the data may be a little bit lagging because of the shutdown. So we have to see about that. And in terms of seasonality, we're entering October. We generally used to historically tend to be more bullish, right? But it's not like superbly bullish, but you can still gain something from this month historically. You need a fear and greed, we're in neutral territory, as mentioned last week. So this probably doesn't change much week over week, but I just like to keep things accounted for. So market momentum, we are very far off the 125-day moving average, but this is slightly skewed because of the deep drawdown in April from the economic the tariffs, right? So there could be some skewness in this sense, but the actual, if you take into account the actual maybe 90-day, 60-day moving average, we probably the divergence shouldn't be that far off, right? Stock price strength, we are in a greed mode. Stock price breadth, we are in fear territory, but it doesn't really feel like it, right? So the names that I like to keep watch out for, they're generally still performing quite decently, right? Puts and calls are positioning, so we're in extreme greed territory. We are not really that hedged, so if anything happens, we can expect this to jump up as traders start to brace themselves with volatility again. VIX, we are pretty flat as well, so nothing new, nothing unexpected now that pops out to bite everyone, right? Any tariffs announcement these days are sort of neglected by the market already, so we need something fresh to spike volatility again. But when this comes out, we'll never know, right? But just that as time passes, right, the more time passes by, the higher probability of the VIX spiking out of the blue, right? That's my take on things. It could just remain like this forever, right? But who knows? So all things considered, we should remain long for now. That's my take. Cautiously long, right? US total assets held by all Federal Reserve Bank. So this doesn't change. All this data doesn't change much week to week, but I just like to just to get all this data to refresh my stance, right? So U.S. total assets held by all Federal Reserve banks still not increasing yet. So if you remember that quadrant I showed you, you want increasing liquidity while interest rate cuts. But so far we're not seeing that the huge liquidity injection in the market yet. M2 money supply is increasing though, but the Fed is not expanding its balance sheet. So FINRA margin debt. So we are seeing margin debts go above the highest that it has been in the past 2.5 years or so, right? As the market's headed up. So, but I think naturally this is normal, right? As the market heads up, you probably see more people take on some form of debt to finance their investments. US Treasury yield was the Fed fund rate, so didn't change much last week. It sort of like went up and then it went back down. Like I think traders were expecting cuts after you see the week non-farm employment change numbers, right? So nothing much to make from this at the moment. Yep, and this is reflected in the expectations, right? So the markets are more or less expecting more or less certain that a rate cut will happen in October, 25 basis point rate cuts, while the market is still increase their bets for a further rate cut to end of the year. So yeah, I think this is most likely the case that we're headed now. So anything that deviates this path, maybe like next week, this month's inflation number is like, I don't know, like way off course or something, way off the expected to the upside, then probably we'll see this shake things up, and then then we'll see the markets pull back heavily. But as of now, don't think that would happen, right? Valuations wise, as mentioned before in my previous videos, it is very high, so shouldn't go all in on these prices now, right? Your PE ratio, your PS ratio, Schiller PE ratios are all quite high. And if you take into account your forward PE ratio for the S&P 500, it is also near sort of like a 5-year high, right? So you have to, this is not the right pricing to go heavy in your investment. So you should, be patient before you go heavy, right? Looking at COT positioning, not much, but in particular to note, right? So your S&P 500 positioning feels neutral to me at the moment. There's no extremity relative to recent times, right? Same thing for the Nasdaq, but there is some form of bearish divergence. As you can see, your small speculators are reducing their longs, while your large speculators and your commercials are more or less flat, but prices are going up, right? The Dow Jones, likewise, the bearish divergence is forming. But what I like is that for the small caps, right, your small speculators are going long, and you are seeing a gap sort of still closing down, right? So there could be some form of opportunity to go, take your longs here instead of going on to your big and mega caps. USD, to me, it feels like it has bottomed up in the near term, so might be a good time for foreign investors like me, especially, to change my local currency in USD to prepare for any longs. So let's look at the economic calendar for next week. So number one that's up is the FOMC meeting minutes. It's important because it gives a sense of the unity of the Fed at the moment, because there's Miran is now in the mix, right? And his stance is quite polar opposite of whatever the members have for now, right? So this gives their thoughts on balancing out employment versus inflation and their economic perspective. But I think in general, it shouldn't move the markets that much, right? Because this is a lagging report. That's one thing to note. It's usually released 3 weeks after FOMC itself. So the effects of the interest rate cuts or any their thoughts and the perspective in the markets are likely to be priced in already, because some of these members have already spoken publicly within this 3 weeks of when the report's coming out and the actual FOMC itself. So the perspective is already likely baked into the market already. Yep. So you shouldn't be at the extreme, right, unless you see something that's superly odd, but that usually isn't the case. Number 2, employment-related data and other economic data. So unemployment claims and non-farm unemployment changes, unemployment rate will be released this week. So, and also there is also consumer expectations and inflation expectations. So let me zoom in a little. Right, so this is happening on Thursday and Friday, right? So I think that for now in this current market environment, bad news is good news in a sense, right? Because we want the data to support Powell's give him certainty to cut rates, right? So it gives him the answer that he needs to whatever question he has in his head about interest rates path going forward. So if it's very clear cut, it's a slowing economy, right? Then and inflation expectation is going down, then yeah, he should cut rates, right? Number 3, tariff related news. So I think it was quiet on this front last week. So maybe there is any surprise this week. Nobody will know. But as mentioned previously, we are past the stage where tariffs heavily impacts the market unless you get like a very, very extreme kind of stance again by Trump and the other trading partners or even rivals, right? Earnings this week is pretty quiet. There's only DAL, Delta Airlines, and PepsiCo that's reporting. That's interesting to me, but nothing much. So you can use StockPenguin.com's earnings calendar tool to see how these companies perform, right? All you have to do is just click on it, and see how it will perform in the coming earnings, and also how it performed historically. Did it beat, did it miss, things like that, right? Not really loading the fastest now. But you get the point, right? You can just take a look at it. Quick takes. So at the moment, the Fed cut narrative is still aligned with the market. No matter what the Fed says, data is showing that there is weakening inflation, though sort of sticky, and weakness in the job market. They most likely cut. Small caps and growth names still looks the most promising to me, despite lofty valuations in general, right? So all of these small caps have their own kind of a niche group of investors, their own fans, their own like valuation kind of their own unique valuation to it as well. So I think this presents the most opportunity rather than you go invest in the Magnificent Seven when it's quite heavily valued now. There probably isn't much meat to it, and just don't see the RR there compared to the small caps and growth names, right? Again, I do not expect much volatility next week, which should end up green in a seasonally bullish October. So let's take a look at the performance of my stocks that I recommended last week, right? So number 1, it's Exxon. This is a company that I actually placed a buy order for, but missed out. I actually was super greedy to place it somewhere here, expecting like a week to take things out and just continue spiking it back up. So more or less flat for the week, right? So I think there is still opportunity for me to get onto this. I like this company because it's a hardware software kind of play, especially in the defense sector where it's very niche, right? And there's strong growth. So I'll explain more in another video why I like this company. But this is something that I would still be keen to invest into. Number 2, Celsius. So Celsius to me was a pure technical trade play, which I should have long but it went up, right? So not the ROI from a technical perspective isn't there now anymore. So if you missed out on this trade, then probably you shouldn't chase it at this price, because I was actually waiting for it to hit around the 49.50 mark. A bit greedy on the entrance, but I should have, on hindsight, if I see any strong bullish candle, even this one, right, I think it will be a good chance to enter. It's some form of gain here, about 10%, which is not bad, right? And if you close at the top, maybe more than 10%. So that was a win. Okta, I think this was completely flat as well. There wasn't any momentum. So good that I didn't enter this as well. UNH, likewise, I think it's still consolidating. Nothing much happening, right? Just like trading around its mini range. So I think the next catalyst for it will probably be its earnings or any new policy updates announced by the government, right? That could spark it higher. But for now, it should probably stay muted. Number 5, Circle. So the whole crypto stock space actually performed pretty decently last week. So if you're long, right, from here you're probably up. I still think it's in a good position to long, especially since if it's above the previous resistance high, you can probably take a long for it to go back to 170 levels. So because Bitcoin just broke its all-time high, and as it enters price discovery mode, and historically I think Bitcoin used to perform very well in October, it could lead to Circle stablecoin kind of going back up to the $170 range, right? So I think this is something I might watch this week as well. It's BMR and Ethereum. So Bitmine, I'm not directly long this itself, but my brother he is long this stock, so I think his average price is around 48, 47. So he's in the green now. But let's see, right? This sort of like if you're a chart guy, it looks like it's forming a kind of like a ascending triangle. Let's see if it breaks out and manages to go back higher. But I think I still like this as Ethereum catches up with Bitcoin. But now, as Bitcoin enters price discovery, I expect the altcoins to stay muted for now until Bitcoin hits a point where like a sort of like a consolidation zone net, right? I'll probably see liquidity flow out from Bitcoin into your other altcoins and Ethereum. So just nice. I think it will flow nicely to this company, this stock, reaching the end of its little wedge, and then it will break out from there. That's my take on the technicals. And if you traded Ethereum as well, you're probably in green too. So yeah, I did some longs through Solana, but I won't really mention it here, but because this is a stock with the channel. Yeah. So companies on my technical watches this week: Exxon, as mentioned earlier, crypto, BMR, Bitmine, and Circle, as mentioned earlier. Number 2, Root. So Root, right? A unique case because it broke out and didn't manage to hold. It came back down. I think it's in a pretty decent consolidation zone now for me to enter, which I think I most likely would. With a stop loss. Yeah, this is kind of mixed for me because I like the long-term prospects of Root, right? But at the same time, I feel like I should take it as a technical trade. But let's see. I think I most likely enter it as a technical trade with my stop loss somewhere below at the $81 level, right? Take a long back to its prior high. So let's see. I actually take that. I need some like confirmation in the shorter time zone, maybe the 1 hour time frame. I get a very strong bullish candle here. I'll take a long. But let's see. Novo Nordisk. Let's see. For me, there's a contingency to this. I'm going to see the stock break out from its previous high, retest, and then I'll go for a long. But for now, I wouldn't, because there's a chance that it will just end up consolidating like your UNH, right? So let's see for this as well. Chipotle is another unique case, right? So it's been traded down heavily in the past couple of months, right, up to a year. So let's see if it manages to stay above this resistance level. If it does, I think it's a pretty good long back to at least the $47 price range, right? This is a very strong daily close candle. And if you look at the fundamentals of the company, it's still growing very strongly despite what people say about its its prospects, right? And change of CEO. It's still doing this and it's back to a growth mode already. So let's see. I think Chipotle might be what do we call it, falling knife, because the fundamentals of the company are still intact. But I think there's a case for a turnaround because as compared to other companies like Lululemon, the headwind isn't as strong. So I think there's an opportunity to consider Chipotle further. So yeah, I think that's all for this week. Let me know down in the comments what you think about my ideas and thoughts about this weekend that watch these companies. Thank you.